Good morning. Welcome to Core Services in our Core Belief Series, Why It Matters. Today we're going to be discussing association cash management. And this comes from the audits we performed over the last year and also working with a couple of boards on their budget preparation for the 2019 cycle. I'm John Coggle and I am today's presenter. A little bit about Core Services before we begin. We are focused on audits and reviews within the states of Oregon and Washington, and our primary market is condominiums and HOAs. We also offer advisory services, which are designed to help boards be more effective in their oversight role of their management. So some basic considerations on cash, and it's important to understand that there are three basic primary types of cash accounts that we see on associations. One is obviously that basic operating checking account. It doesn't pay any interest, but the money is available on demand. Next, you'll see that money market account, and the money market account is designed to pay some interest. It has restrictions on potentially the number of transactions you could do a month, either withdrawals or even deposits, and occasionally they carry minimum cash balances. And then you'll finally see those CDs, and CDs do pay a higher interest rate than money market accounts, definitely higher than an operating account, but there are often substantial withdrawal penalties where you forfeit some amount of the interest that you've have earned. And there's often those minimum purchase requirements, $2,500 or more for an individual CD. So when we go and we start talking to boards, we want to make sure they understand what we consider excess cash. And excess cash is really cash is sitting in your operating account, not working for you, generating interest or any type of return. Well, obviously that begs the question, what's excess? And so what we do is we establish a baseline, and our basic rule of thumb is two months worth of operating cash. So if you look at your budget, you divide that by 12, multiply it by 2, that tells you how much cash you should carry maximum in your operating account. There are other ways, another way we do it, if collections are fairly consistent month to month, or we get a lot of owners prepaying, we recommend holding only 10% of it in the operating account. So you can put the rest of that to work. Let it generate some returns for you. Pull the money back in to pay your bills as you need it in the future. The next step we take is we look at those things that potentially could exceed budget because something went wrong, also known as Murphy's Law, and we help boards understand that those are specific risk identifiers that we want the cash available, but not necessarily sitting in the operating account because it may not happen. And so we go through the budget and we look at those items where there could be substantial deviation from budget because of unanticipated repair needs. And then finally, if there's excess cash at the end of all this, our recommendation is to transfer it to the reserves. The reserves are historically underfunded for the vast majority of associations, so putting the money in there and then getting that money to work at a higher rate of return because you're not going to touch it for several years is a great strategy to minimize the future pain of a potential special assessment. So cash management, how do we go about it? So obviously our first step is we look at how much cash is in the bank, we look at the operating budget, and we have a conversation about the Murphy's Law situation. What things could potentially go wrong? In this case, this client they had 75 grand in the bank, operating budget of 150, and they had an elevator, single elevator in the building. It was older, but it obviously wasn't near its replacement cycle, and they'd spent $8,000 on it. So we do the math. We come up with a cushion of $25,000. That's how much cash that they should be holding in their operating account to fund their operations for the next year. So you'll notice obviously a $50,000 excess cash. We talked to them about how much money we should hold near term in the event that the elevator malfunctions and we need to spend it. And so they came up with a number of 10 grand just to be on the safe side. Okay. So we then said, what are we going to do with that 40,000 extra? Obviously, what we've looked at is their reserve is only about 25% of its threshold funding level. So we recommended transferring the rest of that into the reserve and buy a 36-month CD. They're an Oregon association, so Oregon has restrictions on types of investments, but they weren't going to be touching it for at least 3 years. The interest rates were reasonable, about 2.5%. So when we compare that to where they would have been originally, zero on that money, they would have earned over the course of a year additional $1,000 on transferring that money around to make it work for them. Obviously, we're accountants. We take the tax effect into that into consideration. So, but still, the net increase to the reserves was about $900 for making that excess cash work for them. And over a 5-year period, that came out to about $4,500. Not bad. It's basically worked out to be a month for every one of the owners of their assessments. A different one, similar issue. Obviously, we come in and we help them. We're looking at their cash. They have an operating budget of $840,000, and they're sitting on $265,000. Their two primary issues were their elevator. They knew that they were spending a lot of money. They had multiple elevators. They had contracts on their repairs. But they obviously know things can go wrong with the elevators, and they do need those elevators to get up to 7, 8 stories. And then they were spending money on legal. They were having some issues with a couple of the owners, and so legal was one of those things that could potentially vary widely from what they were anticipating in their budget. So when we do the cash cushion calculation, we come up to $140,000. So they're sitting on about $125,000 of excess cash. When they looked at what they were comfortable with, elevator, they were saying, okay, look, some of this stuff is obviously still under warranty. The elevator is only 5-7 years old. We're not potentially seeing any real problems. Let's put $15,000 of that excess cash towards the cushion for the elevator and a few $1,000s for the legal. The rest of it, they were able to transfer to the reserve, and they were able to buy a bond. This is a Washington association. They have a little more flexibility as to their investments. So what were they originally going to earn? Nothing. By moving the money around, obviously we get a little bit of the interest on the contingency, but they were going to make almost $4,000 of additional interest on that reserve through the bond. We take the tax effect into consideration. The net was going to be $3,000. So over that 5-year period, we're looking at about almost $16,000 of additional earnings inside that reserve. So why does it matter? Well, just recognize that money is important, and having idle cash is really not helping your association. You want to keep absolutely minimal cash balances in non-interest bearing accounts. Zero returns are just flat out inefficient. You're losing purchasing power. I'll be honest, you're losing purchasing power as it is, because inflation is running much higher than the rates of return on most short-term investments. And again, this also just deals with the practical reality that in almost all instances your reserve is underfunded. So moving the money to the reserve is simply going to get you closer to hitting 100% of your funding requirement. Obviously, less cash hanging around in an operating account means less risk. So again, if you're sitting on $10,000, it minimizes the risk that an enterprising member of the board, enterprising member of management is going to try and take that money. If you're sitting on a lot of cash, it's just a larger target. And in a lot of cases, we're holding on to the cash because we have a fear of something going wrong, and so we want to be able to pay the bills. But when you really start looking at it, the fear is overblown. And so again, you're looking at, you're afraid of one risk, but the real risk you're facing is loss of purchasing power. And really, if we can get that money moved to the reserves allow you to take a deep breath and say, how soon do I need this money? If I don't need it for several years, I can do greater and greater return opportunity. So I can buy a 60-month CD, and those are paying maybe 3.754%. So you can do a lot more when you have a larger time horizon, and the operating budget is really all about that next 12-month opportunity. Anyway, I hope this has been helpful to understand a little bit more about how you can more effectively and efficiently manage your cash association cash. As always, you can find us on the web at core-accd.com, or you can contact us either through LinkedIn or on Twitter. Have a great day. We look forward to our next presentation.